Hello, everyone, and welcome to one of the most critical phases of any financial examination, audit planning. Today, we're going to unravel why meticulous planning isn't just a formality, but the very foundation of a successful audit engagement. So, think of it as the blueprint before construction. Without it, even the most skilled builders would struggle. So, this is Josie De Leon, and let's get started. So this presentation will explore the key elements and strategies involved in audit planning. So what we're going to learn today, so let's begin by outlining what we're going to cover. We'll explore why audit planning is essential, break down the planning requirements, and learn how to build an effective audit plan and program. We'll also define the scope of the audit and its implications. Why audit planning is crucial. So audit planning is truly the foundational pillar of any successful audit. It's not just about ticking boxes. It's a strategic endeavor that dictates the direction, scope, and ultimate efficacy of the entire audit process. So without this meticulous planning, an audit risks inefficiencies, misallocation of resources, and most critically, the failure to identify material misstatements or achieve its stated objectives. A robust audit plan acts as a guiding force, establishing the overarching strategy and providing a clear roadmap for the audit team, ensuring the work performed is both effective and efficient. So this structured approach also facilitates a comprehensive review of financial statements and internal controls, minimizing potential disruptions for both audit team and the client. The proactive nature of audit planning is a significant advantage. By systematically identifying potential risk and defining audit's trajectory before field work commences, auditors can design procedures specifically tailored to mitigate these risks. So this transforms the audit from a reactive from the word reactive exercise into a proactive process. Which is centered in the risk management, enhancing the overall quality and reliability of the audit report and bolstering stakeholder confidence. So according to PSA 300, auditors should plan the audit engagements. That's because it improves audit effectiveness. So the primary objective of the auditor is actually to plan the audit itself so that it will be performed in an effective manner. The second one is to attain audit efficiency. Although audit effectiveness is the primary objective of the auditor, adequate planning also leads to audit efficiency. Tailoring the audit to the client's business helps the auditor focus on the areas that are actually significant and relevant. So by doing so, the auditor can use resources efficiently, keeping audit costs reasonable while still addressing the most critical aspects of the audit. The third one is to enable the auditor to obtain sufficient, appropriate evidence. So understanding the client's business allows the auditor to identify key risk areas and important financial statement assertions. So this knowledge helps the auditor design audit procedures that are relevant to the specific risk and assertions, enabling the auditor to obtain sufficient and appropriate audit evidence. The last one is a thorough understanding of the client's business and industry. Helps the auditor communicate effectively with management and other stakeholders. It minimizes the risk of misunderstanding and miscommunications during the audit engagement. So when you work with a team and set your goals, planning allows everyone to be on the same page, working toward a common shared purpose. Okay, let's now go to the scope and purpose. Planning isn't a one-time step. It involves a new information as you gathered along the way. It provides a foundation for the entire audit process. So basically, it sets direction for the audit procedures and help us address areas where misstatements are most likely to occur, ensuring that auditors focus their efforts on areas of greatest significance. All right. Now let's go to the factors affecting the audit planning. So what are these factors? First is the size and complexity of the entity. It is assumed that a more extensive planning activities must be done when the client is a larger entity. When the entity is actually more complex, the transactions are more complex, and the organization is also complex. The second one is the key engagement team members' previous experience with the entity. The engagement partner and other key members of the engagement team shall be involved in the planning the audit. So including planning and participating in the discussion among engagement team members. Their experience and insight will greatly enhance the effectiveness and efficiency of the planning process. The third one is changes in circumstances that occur during the audit engagement. The overall audit plan should be revised as necessary during the course of the audit, particularly when there are significant changes in the condition or unexpected results of audit procedures. And lastly is the timing of the appointment of the independent auditor. So the practicability of some audit procedures could be affected by the time when the auditor is appointed to perform the audit. For example, an auditor appointed prior to year-end may observe physical inventory count. But when the auditor has been appointed, like towards sometime in, for example, after the year-end audit, so there's a different audit procedures that need to be done during the time. So there's no cash count during the year-end. No physical inventory count was done because the year-end was already finished. All right. Effective planning begins with deep knowledge of the client's business. This is the essential planning requirements. And then we perform analytical procedures, set materiality thresholds, assess risk, and use all this to create our audit plan and the program. So first one, the knowledge of the business. That's to spot the industry risk. Second one, to find financial red flags. Materiality naman is your error tolerance threshold, while the audit risk assessment is the core of your strategy. And lastly, the audit plan or the program is actually your battle plan. So if you miss one and the audit crumbles, now let's deep dive into these 5 requirements. Know the business, the first one. Here in the essential planning requirements, the first one is knowledge of the business. Okay, know your business. Know the client's business. Why? Why must you know client business? So if auditing a tech startup, you'd focus on R&D, cost, and the IP ownership. How about for a retailer? So for example, inventory obsolescence. So this is not something that's called a trivia, but this is a risk detection. Use client interviews, inquiry with the management, site visits, industry reports to build this type of knowledge. Anything, everything, whatever you can learn about the company and the industry itself. So understanding the entity and its environment is crucial. It gives context to financial data and highlights areas where errors or fraud might actually occur. The second one is analytical procedures. Preliminary analytical procedures involve evaluating financial information through analysis of plausible relationships among both financial and non-financial data. So this helps auditors identify any unusual trends or variances or red flags early on. So they guide the focus of detailed audit testing. Preliminary analytics, for example, this is your financial radar, no? For example, you spot when you are looking at the revenue from previous year, and then of course you compare that with the current year, and then you compare the two. How much was the revenue this year versus last year, and then you spot the difference of 30%. So there's a 30% revenue, for example, surge without market growth, for example. Then you got to ask the client what happened. So you have to investigate, right? there's an increase, for example, in the increase in the salaries and wages. There's salaries and wages, it's the amount, but there's no employee, for example, there's no new hire, but then your salaries and wages increase. So what happened there? You ask the client, you take a like high level view of the record, but usually you do that by near interview or inquiry. Probably there's a salary increase, most likely salary increase, or there's probably an increase in the benefit of employees. So those things, no? Okay, the analytical procedures techniques, this is what I was mentioning to you about. Horizontal and trend analysis. For example, you can use that. Vertical analysis, ratio analysis. This is something that you probably learned from your financial accounting already. Okay, let's go to the next one. Analytical procedures. Okay. Need to go forward. Okay. Procedures when applying analytical procedures. All right. Develop expectations regarding financial statements. You compare it, as about I mentioned to you, you compare prior year's financial statements, the annualized interim financial statements, and anticipated results such as the budget, forecast, or projections, typical relationships among financial statements, account balances, industry averages. You can also look at some reports within the industry. For example, it's a BPO. You look at the BPO industry, no? And then if it's a banking, you look at the financial and banking industry, investment industry. Non-financial information, okay. The second one, compare expectations with the items presented in the financial statements. For example, if the IT, BPM industry, you know that it's growing, the revenues are usually going up, but then this client of yours, you see that the revenue is actually going down, then you got to ask questions. If, for example, in the banking industry, you know, there's the expectation because the industry as a whole is growing, and then you got a client that with the revenue of going down, then you ask questions. Or it's the other way around. It could be vice versa. For example, the banking industry's revenue is going down, then your client's revenue is going up. So there could be an anomaly, but there could be an error. There could be something that's actually triggering this revenue growth for this particular client, no? Okay. The third one is define and investigate significant differences. So how do you do that? You inquire from the management, and then you corroborate the management responses because you ask different people, you know. Consider additional audit procedures. So based on what the management is talking about, versus what was actually recorded in the books, if there are some anomaly with the answers and with what you actually gather, then you perform additional audit procedures. Okay. All right, now let's go to materiality in planning. Materiality affects everything in audit planning. If something is considered material, it will receive more attention during testing. Materiality is a concept that aids auditors in determining what is significant enough to influence decisions. Establishing materiality thresholds helps focus the audit on areas that potentially impact financial statements. As mentioned in previous slide, investigate any fluctuations, for example, 30% revenue growth. Another example is for example, 1 million profit. Set the materiality, for example, at 50,000 to 100,000. So that's going to be your threshold, no? However, qualitative factors matter too. For example, you found out there's a 10,000 peso fraud. So this is material. All right. Let's go to 3 levels of materiality in audit planning. First level is the overall financial statement level. The maximum misstatement that won't affect users' decisions guides the audit scope. The second one is the assertion level materiality. applied to specific account balances, classes of transactions, or disclosure. It helps identify significant risk. And the third one is the specific assertion level materiality. Lower threshold for high risk or sensitive items, for example, related parties. Compliance disclosure requires extra auditor, for example. So materiality is based on, it's always based on professional judgment. And this is a key to efficient and effective audit planning. If you set your materiality threshold or level low, it means you need more effective and extensive audit procedures. All right. Assessing audit risk. So audit risk is defined as the risk that the financial statements taken as a whole contain a material misstatement. It represents the possibility that the audit work may not lead to a proper conclusion or that the audit outcome may not be fully supported by the evidence gathered. So that's the audit risk. This aggregate or the total risk is composed of three distinct yet interconnected components. We have the inherent, control, and detection risk. I will deep dive into this three audit risk in my other video tutorial, but because this one is only for more of like an intro type. So I will have a separate tutorial video related to risk assessment. A lot of times, questions related to CPALE exams are related to inherent, control, detection risk. So it's really important that you master this type of audit risk. No? So the lower the detection risk, we can accept. I mean, we can accept not really risk is low, okay? The more rigorous procedures will be. Okay, now let's go to identifying potential risks. Identifying potential risk includes assessing factors such as possible fraud, errors in financial reporting, and any changes in regulations or business operations that may impact the audit. For fraud assessment, so evaluating fraud, potential fraud is crucial to ensure the integrity of financial reporting and maintaining trust. Error detection. Identifying errors in financial reporting helps prevent misstatements that could influence decision-making. While regulatory changes, monitoring of this in regulations is essential for compliance and risk management in audits. What are the risk assessment techniques? So the risk assessment techniques involve various methods to evaluate the likelihood and impact of identified risk. So these techniques can include questionnaires, interviews, and analytical reviews. Questionnaires are a valuable tool in gathering quantitative data on potential risk and their impacts. Conducting interviews allows for qualitative insights. Remember, qualitative insights into risk from key stakeholders and experts in the organizations. So you speak with different levels, no? The management, you have the middle managers, lower managers, supervisor, and even with associates or staff. Analytical reviews provide a comprehensive analysis of risk through data assessment and expert evaluations. Strategies for managing and mitigating risk. It involves implementing specific audit procedures, enhancing internal controls, and utilizing technology to monitor risk continuously. So the implementing audit procedures help identify and assess risk, ensuring effective monitoring and management of potential issues. Strengthening internal controls, it reduces the vulnerabilities and enhances the organization's ability to manage and mitigate risk effectively. Utilizing technology plays a vital role in continuously monitoring risk, providing real-time data for effective decision-making. Now let's go to the audit plan. The overall audit plan is our strategic blueprint. A comprehensive audit plan includes audit objectives, resource allocation, scope and methodology, timelines and reporting, and coordination with internal auditors and experts. So let's discuss this one by one. Audit objectives. Defining clear audit objectives is essential for ensuring that the audit meets its intended goals and provides valuable insights. The second one, establishing the scope and methodology guides the audit process, ensuring that it covers all necessary areas and employs effective techniques. While resource allocation is also vital for the audit success, allowing the team to effectively address all aspects of the audit. Timelines, reporting requirements. Setting timelines and reporting requirements ensures that the audit is completed on schedule and results are communicated effectively. Coordination with internal auditors and experts. Experts play a vital role in audit planning by providing specialized knowledge in areas such as IT, taxes or taxation, and accounting standards. Their contributions enhance the audit's quality and reliability, while effective coordination with internal auditors and other independent auditors is essential to ensure comprehensive coverage of the audit scope, reduce duplication of efforts, and you both share insights. All right, need to move. All right, let's go to the audit program. While the audit plan is high level, the audit program is more detailed. It lists specific tasks, tests, and documentation requirement for each section of the audit. So in conclusion, effective audit planning is essential for achieving audit objectives and managing risks. By understanding the scope, fulfilling essential requirements, and developing a comprehensive audit plan, auditors can enhance the quality of their audits. So in my next slides, we will answer 5 CPALE exam type questions. Okay. Now, let's go to the next slide. Let's test your knowledge. Okay. For question number 1, what is the primary purpose of preliminary analytical procedures in audit planning? A, to finalize the audit opinion. B, to identify risk of material misstatement in financial statements. C, to conduct detailed substantive testing. And D, to prepare the final audit report. The correct answer is letter B, to identify risk of material misstatement in financial statements. So preliminary analytical procedures serve as a tool to survey the accounting landscape for potential material misstatements and help auditors the overall audit strategy. Okay. Question number 2. Which of the following is considered the only component of audit risk that the auditor can directly control? Remember, this is the auditor can directly control from that word. A, inherent risk. B, control risk. C, detection risk. And D, business risk. Okay, the correct answer is detection risk. Detection risk is directly linked to the auditor's skills and procedures. From the word detection, so you're like an investigator, no? The investigator can do, the investigator is like an auditor. What you can do is to detect if there are errors, if there are material misstatement, if there are fraud. So that's why from the word detection, think of it as the investigator. Okay? So that's the only risk that can be controlled by an auditor. Let's go to question number 3. Okay. What does the principle of fair presentation in auditing primarily ensure? A, that auditors are free from conflicts of interest. B, that conclusions are rooted in verifiable facts. C, that findings, conclusions, and recommendations are reported without bias or distortion. And D, that sensitive information is protected from unauthorized disclosure. The correct answer is C. You're right. So fair presentation is about accurately conveying the facts uncovered during the audit process, regardless of whether the results are favorable to the organization. Remember, the fair presentation, from the word fair, means no bias. That means no distortion, objective. Okay. Now let's go to question number 4. Which of the following are the 3 components of audit risk that an auditor considers in a risk-based audit? A, inherent risk, control risk, and detection risk. B, strategic risk, operational risk, and financial risk. And C, market risk, credit risk, and liquidity risk. Letter D, compliance risk, reputational risk, and technological risk. So, the correct answer is, okay, oh, I have paused video now to think. Letter A, inherent risk, control risk, and the last one is the detection risk. Okay, these 3 components make up the audit risk model. Remember, there's a model that I showed you in the previous slide. The IR times CR times TR. So that's your total audit risk, okay? Okay, our last question. Which of the following is not an essential audit planning requirement? Okay, A is risk assessment. B, performing substantive procedures. C, knowledge of the business. And D, setting materiality. So the question is not. So let's go to the letter A. Is it A? Is it B, substantive? Is it C? Do you need knowledge of the business to start, to start planning the audit? Or setting materiality threshold? Okay. Pause the video now to think. The correct answer is letter B. You're right. Because risk assessment is check, knowledge of the business is check, setting materiality threshold is check. But performing substantive procedures is already part of the audit execution, not planning. Okay, thank you for watching. We hope you enjoyed the content. Please like and subscribe to my channel for more interesting videos. So your support means a lot and helps us bring you more valuable and engaging content. So in my next video, we will do some more CPALE exam type questions. But if you want some more questions, you can comment in the comment section below.